Good evening, students. In today's class, we are going to learn about the first unit. In that, we are going to learn clubbing of income. According to the rules of the Income Tax Act 1961, every person have to pay tax on all the taxable income he is going to earn during the previous year. Our current previous year is 21-22 and our assessment year is 22-23. Whenever you are going to calculate the total income, if the income of any other person in a family is included, then this added income or inclusion is called as the clubbing of income under section 64 of the Income Tax Act 1961. Clubbing of income, it ensures that the taxpayer do not evade any of the tax liability by transferring their income to any other person income. Either it can be income or the asset which is going to generate the income. Now, we are going to discuss the provision relating to the concept of clubbing of income tax under the Act under the following heading. First, we'll learn what is clubbing of income, then why the income of a person associated to be a club, reason for clubbing of income, then what are all the various examples of clubbing of income, then what are all the various rules related to clubbing of income. Under that, we are going to see transfer of income without transfer of asset, revocable transfer of asset, clubbing of spouse income, remuneration to spouse, income from asset transfer to spouse, income from asset transfer to son's wife, income from asset transfer to benefit the spouse of the transferor, then income from minor child when the child income does not qualify for clubbing, investment in minor's name, then income from self-acquired property converted to joint property, implication in case of subsequent partition. So these are all the various things we are going to cover under this clubbing of income. Now for us first to learn what is the clubbing of income meaning. As per the Income Tax Act, every person has to pay taxes on the taxable income he is going to earn during the previous year. No person is allowed to divert or evade his income. Divert his income to any other relatives to reduce the tax burden or evade the tax. Now, the clubbing of income means an income of other person is included in the assessed total income while computing the income tax payable. Now, who are all the person whose income will be included? It can be the income of the wife, daughter, son, daughter-in-law, or any other relatives. Now, next one we are going to learn about the reasons for clubbing of income. Now, many taxpayers in any country, they'll attempt to reduce the tax liability by transferring their income and asset to the family members or the relatives in such a way that most of the income falls under the non-taxable amount, because they will be taking those person whose income is very less and they'll be transferring the asset or the income so that the tax liability will be very minimum. Now, not only in any parts of the world, but in India mainly, we are just talking about Income Tax Act 1961. So it is we are talking about the tax system in India and clubbing of income in India. Now, the clubbing of income regulations ensures that those practices are curtailed or clubbed and nobody evades the tax. Now, what are the various example of clubbing of income? First example, investing money in the form of fixed deposit in the children name, earning assets in the name of relatives, wife or children, then creating saving bank account for dependents, mutual funds for the child, shares in the name of the spouse or child, post office savings for the family members. So these are all the examples in which case the assessee is transferring the income to other person. Now, any person who is going to earn the income will not be taxed. Why? Because this is not their income, it is the income of the assessee. So this income has to be clubbed with the person who has earned the income. If a taxpayer transfer the ownership of an asset and the income from asset to a dependent, it will be continued to be added to the taxpayer or the assessee income under the clubbing of income tax provisions. Now, for example, if a person is purchasing a flat in the name of a family member and the other person lets out a flat on the rent in the family member's name whose name we have purchased a flat, the rental income earned by that person, will not be taxed in the name of the person who has rented it. but it will be taxed in the name of the person who has purchased the flat under the section 64 of the Income Tax Act. Okay, now next, clubbing of income rules. Now, what is the rule? Clubbing of income, it relates to the income from investment made on behalf of the family members. Example, spouse, minor children, daughter-in-law, okay, or the relatives. These incomes are joined or clubbed together and taxed on the overall income of the assessee. Now, the following are the major rules. First one, transfer of income without transfer of asset. What is the meaning? You are going to transfer only the income and not the asset. When a person is going to retain the ownership of the asset, but it transfer the income from the asset to any other person by way of an agreement or any other means, then as per section 64 of the income tax, such income will be taxable in the hands of the transferor alone, and the assessee will be with assessee's income, the income of the transferee will be clubbed. The following explanation illustrates the concept of income transfer. Now, if a person owns 10,000, 50% debentures of ABC Limited, at rupees 500 each, he is transferring the interest income to his family member spouse without transferring the ownership of debentures. In such a case, whatever interest they are going to receive, it will be taxed in the hands of Mr. A. Second one, revocable transfer of asset. If any asset is transferred under a revocable transfer, income from such asset is taxable in the hands of the transferor and not the case of the transferee. Then clubbing of spouse income. Clubbing of spouse income is the most common because whenever a person is not going to have much source of income, then income of a person who is going to have limited income will be clubbed with the income of the person who is going to earn higher. The following are some of the major aspects of clubbing of spouse income. Under this, first one is the remuneration to spouse. A person income is to be clubbed with the spouse income if any payment is received from the spouse through the following methods. Salary or remuneration paid to spouse directly. Wage or remuneration or commission paid to spouse from a concern in which the assessee has a substantial interest. Substantial interest is coming under three category. If I going to have 25% of the share capital in any company, more than 25%, then I am a director of a company, or I am earning more than 50,000. I am a specified employee. In all the three cases, I am have substantial interest in the company, and the spouse income can be clubbed with the income of the assessee. Then next case, income from asset transfer to spouse. If an asset is transferred by a person to his spouse directly or indirectly, any income from such asset will be considered as the income of the transferor. Then income from asset transfer to son's wife. Any income which arrives from the asset transfer directly or indirectly by an individual to his wife's name, otherwise than for adequate consideration. Now, the income, if it is going to generate, then it has to be included in the income of the transferor and not the transferee. The next case is the income from asset transfer to benefit the spouse of the transferor. In this case also, the transfer will be taxed and not the transferee. Next one is the income from minor child. A minor child is a person who has not attained the age of 18. So any income of the minor child is to be clubbed with the income of the parent whose income is higher. In case of death of both the father and the mother, it will be clubbed with the income of the legal guardian. Then it must be noted that income once included in the total income of either of the parents could continue to be included in the hands of the same parent in the subsequent year also, unless the assessing officer is going to be satisfied that it is necessary to change the person to whom the income has to be clubbed. Additionally, if a child attends majority during the previous year, then part of the income earned by the child during the minor period would be clubbed in the hands of the parents. And if any minor income is clubbed, now the parents is allowed to have a deduction of 1,500 under section 80U. Then clubbing of income is applicable if a person transferred an asset without adequate consideration to son's wife or daughter-in-law. Any income from such an asset would be considered as the income of the transferee or the assessee. Now, the law contrary to this, when a child's income cannot be clubbed with the income of the parent, whenever the child is going to do any manual work is done by the minor, then activity involving the application of skill, talent, or specialized knowledge and experience through which the child has acquired any income. In this case also, the income of the child cannot be clubbed with the parents. Then thirdly, the child is suffering from any disability specified under section 80U. In three cases, the income of the child cannot be clubbed with the income of the parents. So investment in minor's name, if the asset is not in the name of the parent, but it is invested, and any income is going to earn out of the investment, then those income will be clubbed with the income of the parent. The next case, income from self-acquired property or converted to be joint property. If self-acquired property of an individual is converted into family property without an adequate consideration, then the income derived by joint family on account of such property would be included in the total income derived by the joint family on account of such self-acquired property. Now, if an individual who is a member of Indo-undivided family, if he is going to convert his separate property to HUF, or he puts a property into the common stock of the family, or transfer his individual property to the family, otherwise for the adequate consideration, then the income of such property would be included in the income of the individual or the transferor. Whenever they are going to subsequently partition, then it will be again, once again it will be tax in the hands of the transferor. Okay, these are all the cases. Here we conclude. In the next session we will be learning how to compute sums under clubbing of income. Thank you.